Yeah. Okay. Good evening, everybody. So um, today we are discussing about week 10 content of our financial mathematics course. It was more or less focused around mutual funds and options. Okay, and some cost of capital, etc. Some brief introduction were there. But the thing is, after COVID, mm, many of the many of the Indian citizens have been introduced to the stock markets or equity markets. Okay, so therefore, like the number of people who knew about mutual funds, net asset value, options, etc., various things related to the equity markets have been increased dramatically after COVID-19 in India. Earlier, it might not have been that much, but for sure, after COVID, it is quite significant. Okay, so therefore, we'll discuss some basic things about it. But apart from that, I'll just show you some websites also where you can get more information about those things. Okay, so you know, and along the way, we'll take some problems also, numericals, simple numericals. And actually, this week's class was postponed from last Tuesday to today. So therefore, the deadline for submitting assignment is also over. So we can discuss that part also. But you know, I mean, we'll discuss similar problems also, nothing like that. But as the concept of mutual funds is considered, as far as this concept is considered, it is nothing but uh, it is not possible for each and every individual to invest in stock markets because first of all they might have some other commitments, and second of all they might not have knowledge of investing. Okay, because this is also a specialized field, and the harsh truth is like if you consider retail investors, like retail means common investors like you and me who are not like specialists in those fields, finance, etc. Most of them lose money in stock market because they don't know the fundamentals of investing, the fundamentals of uh, stock analysis, or in a, and many other things. So what they do, uh, like in any concept or any other thing in your life, when you don't know something, you go and take help of experts. For example, if you are sick and if you don't know what happened to you, you go to the doctor, you pay the doctor some fees and get the medicines that you require. Okay. Similarly, if you have certain money, uh, before COVID, the culture in India, like the broad culture in India, was to save money using fixed deposits or gold or some sort of fixed deposit asset. I mean, fixed income assets. Okay. I mean, not fixed, like safer ones, because usually it is considered now also in many Indian families, it is considered that the stock market, etc., is gambling, and you lose the money uh, if you do such activities. Um, this is one of those things where there is truth to this statement, or and there is uh, negligence also behind this statement. So those who say stock market is gambling, they might have themselves lost the money in stock market because nobody tells this, but uh, you know many people lose money in stock markets. Okay, the percentage may vary, but if you consider the retail investor as a group of investors, or they might have seen somebody else losing the money in the markets, and therefore they are risk averse. Okay, so anything might have been in their background, but that's why they say stock market is gambling. But it's not like that. So see, gambling is pure gambling. For example, nowadays, if you have seen this, you are seeing these IPL matches. The number of ads of these betting sites or betting apps that they are showing, That's like a gambling, okay, because there the odds are not like, you can't decide the odds. It's all random, or it's all probabilistic. So it's purely based on your luck. I mean, one can argue that some skill is required to make the team of 11 cricketers, but nobody can prove that one can choose the best team that will perform today before the match using some scientific method. It is, or some definitive scientific formula or something. It is all probabilistic, and those who are lucky, or those who's in favor, the probability works on that, then they win, and most of the others lose. Okay? So then, when it comes to stock markets or equity markets, or even for that matter, bond markets, etc., if you know how to do these things, then it's not gambling. Then it's a branch of science, mostly probabilistic science, not a deterministic science or maths, whatever you want to call it. But it is probabilistic in nature. Okay, so the best of the best investor also can lose money. So that is the risk that is called as inherent risk or systemic risk with the equity investing. Okay, but that doesn't mean that you will gamble. Okay, it's not gambling. It's like a like some sort of structure is there to it if you know how to do it. Okay, so that's why what people do usually, they go to mutual funds. Normal people like us, people like who doesn't have or who don't have much of a large funds, etc. So they go to mutual funds. And earlier, before COVID, it might have been difficult to access various information about mutual funds. But nowadays, it's very easy. You install a couple of apps like Grow, and maybe one or more are there, and you will get different types of mutual funds. Okay, so mutual funds are basically where you pool the money and you give it to a fund manager. So we assume or we believe that the fund manager is a well-educated person in this field, and he or she will be able to give you better returns than the risk-free rate or FD or whatever you want to call it. Okay. But there also it is assumption, right? I mean, there are mutual funds who don't make more than FDs in in certain number of years. So again, that is part and parcel of the game. Okay, so that is what mutual funds are. Okay, so so the advantages that mutual fund have is basically, uh, you know they have dedicated personnel who are who belong to that field or field of finance, working on finding suitable investment opportunities on your behalf, and they charge some fees from you. Okay, so there could be any name to that fees. Someone may call it as entry load, exit load, or some other fee. Okay, so all those kind of things are there. Plus taxes are also there. Usually, uh, in our country, taxes are everywhere. That is true in every other country also. It should not be said like that only in India taxes are high. The problem is in India the taxes are there, but the corresponding uh, returns are not received by the taxpayers. That's the issue here. Anyway, that's not the point. So here basically you pool your money and give it to fund manager, and since you have a large amount of money, uh, that becomes then you are or you can take better risks, or larger stakes you can take in certain companies which you are confident about. Okay, so that's the idea of mutual funds. Many of you may know it. So then there are some other advantages. For example, mutual funds provide you diversified portfolios. For example, there are some themes under which the mutual funds operate. For example, there are some mutual funds which are based on which are like more towards the fixed income. Okay, so some funds are called as funds for income. Okay, so what they do, they guarantee or they promise you that if you invest certain amount of money in our mutual fund, we will provide you certain income at some interval of time, usually 3 months, 6 months, 1 year, like that. And what they usually do is they invest your money in some bonds. Okay, or dividend paying equities. Okay, so there are certain PSUs, public sector undertakings in India, who are they usually pay stable dividend to the government. But if you are a equity owner in that company, you will also get that stable dividend. Okay, so there is one type of fund which is called as funds for income. So basically, mostly this retirees or people who much don't want to see much volatility in their uh, base capital, they usually opt for such schemes. And then there are some other themes like funds for growth. So this growth is a very tricky thing in equity markets because uh, very few people go for these funds for fixed income because everybody wants as much as they can, but they don't want to lose anything. Okay, so that is why everybody chases growth in this market. For example, a few years back, public sector banks in India were the sector where you could see the growth. Okay, and it happens. Banking is a cyclical commodity nature based business. So there are cycles where bank balance sheets become clean and then they are lucrative because before a couple of years before COVID, if you had looked at the public sector banks, you would not have touched them because they were having the problems of NPAs, scams, etc., etc. Yes Bank, PNB, all those things are example of that. But eventually the cycle reverses because your once the scam is out, the measures are taken to clean the balance sheet of the bank by doing some write-offs and some other measures, changing the board, etc. And then the same company which was untouchable before a few years now looks very attractive, and it do I mean they do perform also for some time. So PNB, it has gone like 3-4 times from their lows. Okay. Similarly, on a global scale, the companies who are doing AIML, artificial intelligence and machine learning related research, or product development, or semiconductor business. Semiconductor sector also is one of the growth sectors. Okay, few years back or few decades back, the IT was the growth sector. Okay, so many people in the stock market or equity markets chase growth because the upside potential is large for such uh, sectors. And if you invest in mutual funds, you may miss out on stocks like you know uh, Nvidia or something, which like became 10 times, 20 times in few numbers of years because you diversify your risk amongst that sector. So you will not only buy Nvidia, or your mutual fund manager will not only buy Nvidia, he or she will buy Nvidia plus other competitors also, with the hope that at least one or two of them will survive and give you the uh, very high returns. But that is the drawback also, right? Because see, the mutual funds is a safer instrument as compared to the direct stock picking. So you diversify your risk, and the overall portfolio risk is less. Is you won't have the extraordinary returns from those one or two stocks on a portfolio scale. Okay, we'll see some examples so that you'll understand. So there are some funds for growth which focus on uh, growing industries. Okay. So in today's context, maybe AIML or semiconductor business or semiconductor sectors. Okay, so these kind of sectors are looked at with optimism. For example, if you do any startup in AIML nowadays in India or wherever you want, there will be more likely chance that you'll get the funding without much questions. Okay. Because that's the hot topic, no? Few years back, electric vehicles was that topic in US when Tesla, etc., was coming up. In India, the problem is our culture is not towards the innovation. It has started in recent years, but we are very far behind the innovation game in India. Uh, not like it's not like anybody's fault. It's just the global scale or global economics how it works. These advanced nations like US have identified that to remain the superpower, you need innovation. That's the only thing that can keep you ahead of all other competitors. But countries like China and Russia, they are also figuring those things out, and there they have one-party democracy. I mean, democracy is just there, but they have one-party system. So implementing such strategies on a national scale becomes easier. In India, the challenge is first of all, we are not a developed country because of colonization, etc. We are uh, lagging behind in the growth or the development. And second thing is our multi-party system. Uh, I don't know whether it's right or wrong. That's not my cup of tea to say anything. But the only thing that I can say for sure is it takes a lot of time to implement certain things or certain urgent things on a national scale. I hope you get my point. And secondly, the problem in Indian context is uh, we allow our top talent to go abroad very easily. Anyway, so let's not go there, leave it. So we coming back to the mutual funds. So these are some of the things that are important for mutual funds. And then there is something called as net asset value. So this was discussed in the class. Okay, so maybe we can take some problems on that. So the net asset value, they use this NAV as the acronym for that. Uh, so I was watching one interview of very famous fund manager in the Indian construct. I think Mr. Arora, his name was, because when Zomato was very hot topic, he gave an interview on YouTube. So I was listening to that interview. So since he's a fund manager, the interviewer asked him what is the main thing that you look every day on your screen. So I mean, normal people like you and me usually we look at the whether index is up or down, or individual stocks where you have more exposure is up or down. But since he's a fund manager, what he said is he only look at one number, which is NAV. Okay. So as a mutual fund manager, this is the main number that we should be looking into. Okay. It is best to increase this number as much as you can. That means your fund is doing great and more money is coming from the investors. So NAV is very important concept as far as mutual funds are considered. And many times people who want to invest in mutual funds, they also look at this NAV, and the fund who is having higher NAV, people think that it will be performing better because they have the capital or the war chest of the capital. But this is one of those points where your size becomes your enemy, because when you are small, it is easy to grow, but once you become significantly large, it is very difficult to grow incrementally. Okay, same thing happened with HDFC Bank. If you had noticed, 20 years back, it was a small bank, so there was a lot of scope for improvement or growth across the national landscape. But once it has become like bigger, bigger in the sense it's like 10% of our whole banking industry now. So now it is difficult to grow. So what they are doing is they are merging the HDFC with HDFC Bank and other things, doing small acquisitions, etc. But on a larger scale, it doesn't matter. They will be, they are very huge. Same thing happens for Infosys, TCS, companies like that. They have see, every enterprise has three growth or three cycles or three parts in their cycle. First is called as growth, where you are a small company or small enterprise who has a very good business model. And then in some cases, if you get government support or something like that, which happened for Infosys, etc., then you grow very fast. Okay, so Nvidia was like that maybe like 10 years back. So that is called as growth state. Then there is something called as maturity state or stage. So where you become fairly big player in your field, and still you have the advantage over others. So then you continue to prosper, but not at the rate at which you had done earlier. Okay. And then there is a third state which is called as decline stage. So it doesn't come to all businesses, but many businesses decline also, especially cyclical or some that kind of sectors who are falling out of the favor in general. Especially this happens in technical sector also, technology For example, Xerox, which was one of the biggest giants when the Xerox technology was the latest one. Now it has almost out of the picture because now it's everything is online and all those things are there. Okay, so that is about companies, etc. But these mutual funds, they track net asset value, and its formula is given as this market value of your assets plus C is cash on hand minus any obligations that you have. Obligations for mutual funds are nothing but the salaries for employees, uh, any taxes or anything, tax liabilities. And also sometimes what happens if your mutual fund is not performing well, in that case there will be large number of redemptions. So basically the people who had put money in your mutual fund, if they are not happy with your performance, then they will withdraw that money. Okay, and in that case these obligations or liabilities will increase. Okay, and then your net asset value decreases divided by S. So S is number of outstanding shares. Okay, so this S doesn't represent the shares of the stocks that mutual fund have purchased. Okay, it represents the shares of the mutual funds itself that the investors have purchased. Okay, because when you go and buy the mutual fund, what you are buying are nothing but number of units of mutual funds. Okay, so that's why this S represents total number of outstanding units of mutual funds, in the hands of investors. Okay, I hope it is clear. Okay, so maybe we can uh, take some problem. Yeah, so there is a mutual fund having market value or the total market value of its assets. Okay, market value of its assets is 10 lakhs. Okay, so this is a small mutual fund, and they have cash on hand of 50K. Okay, so 50,000. So this cash on hand, when do you get this cash on hand? If you are receiving some dividend from the investments, or some new this thing is there, new inflow of mutual fund money is there. This happens usually. You get the salary on 4th or 5th of the month, or in the first week of the month, and then people usually deposit that money in their mutual funds. Okay, so at the start of the month, mutual funds will have certain cash on hand. So usually they wait for certain good opportunities for a few days when the market is down or something, and then they invest that cash on hand. Otherwise, they immediately also do that. So there are different categories there also, but that is what you call cash on hand for the mutual fund. And let's say they have the liabilities of about 1 lakh. Okay, so that means the monthly employee salaries, tax deductions, and any other redemptions, etc. So that is about 1 lakh. Okay, and outstanding shares of this mutual fund are, okay, so they usually are called as outstanding shares of the mutual fund, are nothing but, let's say, 10K. Okay, so that's why, for example, if any one of you has invested in a Nifty Bees or something like that, Nippon India mutual funds who invest in index. So what happens? Nifty is trading at, let's say, 23,000, but you don't pay 23,000 to buy one mutual fund unit. Okay, you pay something like 300 or 400 like that. So sometimes you should wonder, I am purchasing something which is of the price of 23,000, but I am paying only 400 for it. So how is that possible? That is possible because the thing is, you are not purchasing one whole unit of Nifty. You are purchasing proportionately. Whatever you pay, that much only fraction of Nifty you are buying. Okay, so that is why this concept of outstanding shares comes into picture. So in such cases, what will be your NAV? NAV will be nothing but market value, which is 10 lakh. So I'll convert everything into uh, lakhs. Okay, so that's why this 50K is 0.5 lakhs, and obligations are 1 lakh, and divided by the number of units which are 10,000, 10k, that is 10,000. So that is nothing but 0.1 lakhs. Okay, so that is 10.5 minus 1, that is 9.5 divided by this. So this is 95 uh, rupees per unit. Okay. Sometimes they don't divide by the outstanding number of shares. So this will be nothing but NAV per share. Okay. In some cases they don't divide by S, so that is called as absolute NAV. And when you divide by outstanding shares, that is called as uh, NAV per share. Okay. So now you can play around with this formula, right? So there are four variables, MVCSO, also NAV. So five variables are there. I can give you any four values and I can ask you to find the fifth value. Okay, so anything is possible in that context, right? So that is one thing. For example, I can give you one formula or one more question where I'm not asking you to find NAV per share because that I'm giving you. So NAV per share is rupees 15. Okay. Market value of that mutual fund is 12 lakhs. So everything is in rupees. Okay. Cost on hand is 3 lakhs. And they have 1 lakh outstanding shares. Okay. So now what you need to find is find the obligations for this mutual fund. Okay, so it's just a playing around with math, right? So we know that NAV is equal to MV plus C minus O by S. So here NAV is 15, MV is 12 lakh. So let's say this is 12 lakh. Let's convert everything into this thing, rupees. Okay, so then the cash on hand is 3 lakhs. Then obligations are there, and then you have 10 to the power 5, 1 lakh shares are there. So this is nothing but 15 minus 15. So therefore it comes out that you have zero obligations. Okay, because this thing is like that. Okay, so maybe I'll reduce this 15 to 10. So in that case, one second. Okay, so instead of NAV of 15, let's take it as 10. So in that case, your obligations will come out to be 15 minus 5, so 5 lakhs. Okay, so like that, you can play around with this formula. No need to worry about that. So then there was some discussion on this front load, exit load, all those things. So that is in general also very good advice. If you are purchasing any mutual funds, don't just look at NAVs because that's not the main thing that you should be worried about. Because as I told you, the smaller funds also sometimes outperform exceptionally well. Okay, it depends on the fund manager skills, overall sector growth, for which that fund is dedicated for all those things. You must read this Peter Lynch book, uh, One Upon Wall Street, because he also started with when Fidelity was very small mutual fund, but fortunately, when there was overall prosperity in the US markets and even the globes, various markets nationally or globally, So he was, and he was obviously he was a good mutual fund manager. He had that knack of picking up good stocks, and that's why Fidelity became like a giant afterwards. So therefore, NAV is not the only right criteria to judge the performance of your mutual fund, or decide in which mutual fund you are supposed to or you should invest. As far as the retail people or the investors in the mutual funds are considered, this charges, the extra charges that you need to pay to the fund managers or the fund, that is the main thing. Because let's say uh, your fund is appreciated by 10% in some number of years, but if you have to pay half of it to the fund, then that's not good, right? They're taking like 5% out of it. So that is called as uh, fees or loads. Okay. So there are two types of load: front end load and back end load. That is called as entry fee or exit fee also. Okay. So if you have this thing, LF, in the same formula, let's say LF is there. LF is called as front end load. You purchase 1 unit of your mutual fund, whatever is the NAV, you have to pay additional LF, and that you pay the total cost. Similarly, you have LB, which is called as back end load, and that is called as exit fee also. Okay, so usually they call this exit load also in some cases. Okay, so if you are selling your mutual fund units, whatever price you sell, additionally you have to deduct this much from your net profits and give it to the mutual fund as their fees. Okay, so in such cases, the purchase price, PP, becomes equal to NAV into 1 by 1 minus LF, and then selling price becomes SP NAV into 1 minus LB. So you can use capital letters also, doesn't matter. See, this is like a brokerage. When you do some trades, you have to pay brokerage whether you are in profit or loss. Similarly, if you are purchasing some NAV, you have to pay LF, and even if you are exiting from your mutual fund in loss, in that case also you need to pay LB. They may take less LB if you are exiting in loss, but still they will take something from you. Okay, so they are not free for non-profit trade. So they are for profit there, and they will take it from you. Okay. 1 second. Yeah, so maybe we can take one problem on this. So now same calculations of NAV, but you need to include these things. Okay, front load, back load. Okay, so let's take this question. So in this question, they have given you the initial NAV for a mutual fund. Okay, so when you are about to purchase, it was 25 rupees per unit or per share of the mutual fund. Okay, and then LF, the front load is 4%, and the exit load is 2%. So total they are taking 6%. Okay, but what happened after 1 year? NAV was increased to 30 rupees per unit. Okay, so your fund performed well, and now the NAV is 30 rupees. And along the way, you received the dividend from your uh, investment, uh, you know, uh, which was equal to 1.5 rupees per unit. Okay, so whatever units you had for the mutual fund, you had received 1.5 rupees as the dividend. Okay, and the initial investment which you did at the start is nothing but, let's say, 1 lakh. Okay, and now you need to find what is your find rate of return for this investment. Okay, so that means you know, after exiting mutual fund, okay, so that means you sold it after 1 year, and whatever is the net profit divided by initial investment, that will be your uh, rate of return, right? ROI, we call it as rate of return on investment. Okay, so here first of all you should know how many units you bought, right? So what is your purchase price? It's not 25, right? Because you did not buy it at 25. You have to pay front load, right? So that is 4%. So that is 0.04. Okay, that means 25 by 0.96. Okay, so you did not buy the fund at 20. Price was NAV was 25 at the time. You had to buy it at certain premium, which was, you know, that comes around to be 26.04. Okay, so you paid this much money for 1 unit. Okay, and how many number of units you purchased, that depends on how much was your initial investment, right? So initial investment by your purchase price, right? So that will give you the number of units of mutual fund or number of shares of mutual fund that you possess at the start. Okay, so that is 1 lakh. So that is 1 lakh divided by 26.04. Okay, so if you do that, you get around 3840 units. Okay, there is some fractional part there, but I'm just rounding it off to 3840. That will be easy to calculate. Okay, and now when you sell, okay, so your selling price will be nothing but your NAV become 30 rupees, right, after 1 year. So you did not sell it at 30 because you are paying some exit load also, right? So actually you are paying, you are selling it at 0.98 into 30. So that is 29.4 rupees per unit. Okay. So basically you bought this at 26 and sold it at 29, not at 25 and 30. Okay, because of this front and back load. Okay. So gains from NAV appreciation will be 29.4 minus 26.04 into 3840, right? Because those many units you have. Okay, so that will come out to be uh, 12,902.4 rupees. Okay, but you receive dividend also, right? So total dividend received is nothing but 3840, because these many units you had and 1.5, that much you got per unit, right? So that is 3840 into 1.5. It turns out to be 5760. Okay, what is the net profit? Net profit is sum of these two, because you had appreciation in your NAV and dividend also. So 5760 plus 12902.4. So you received like 18,662.4 rupees as net profit. And what is your ROI then? It is nothing but net profit by initial investment, right? So that means 86662 by divided by 1 lakh into 100, because we usually express this in percentages. So that comes out to be 18.66%. Okay. So within a year, you achieved the return on your investment of 18.66%. Okay. So another question could be, I can ask you out of this, how much percentage came from the dividend. Okay, so that is easy to do, because 5760 5760 divided by total, that is 18662.4, that is around 31%. So if you multiply this by 18.66, that means approximately 5.8% of this return came from the dividends and remaining came from the appreciation of your NAV. Okay, so these kind of things, these are very practical problems which you will face when you buy these funds and all those things. Okay, so this is about your NAV and all. Okay, so very important. Some of you who are doing SIP etc., they might already know these things. Okay, anyway, so that is about NAV. So this was you know the content of your first class, and then there are different performance measures for the mutual funds. Okay, the important ones, I mean, there are many ratios like Sharpe ratio or trainer ratio, Jensen's alpha, portfolio return. Many things are there, but in the class only these things were discussed. Okay, something called as, let's say, uh, expense ratio. Expense ratio, ER, not emergency ward. Okay, so expense ratio. So it is, it is nothing but the annual expenses, or total expenses incurred during certain duration. We usually talk annually because everything we consider on some same time scale. So if you are considering annual expenses, you have to consider average for that year. Okay, so this is also called as average AUM. Okay, so into 100 usually, so because this is in percentage. Okay, so first of all, you should understand the denominator is average. Okay, so in India, I think the financial year ends at 31st April, if I'm not wrong. So what they do, mutual funds, etc. See, their average will be calculated based on the price of 1st April of last year, if it is working day, or otherwise next working day, and the last price will be, or the when you take average, the first and last are there, right? So first price will be on 1st April of last year, and the last price that they consider to calculate AUM is the 31st April of present year. Okay, so they take average of these two prices, and that is called as average AUM for mutual fund. So therefore, usually what they do, uh, if the fund is not performing well for whatever may be the reason, towards the end of this April, they do huge buying, okay, so that this average AUM number increases, and then you can show expense ratio. Then at the opportunate time in the next year, you sell that, so that your next year ER doesn't get affected. So these are some practical things. It is also called as window dressing. You might have heard this term. I am not sure, but these are some these things. Okay. So then there is something called as total investment expense. Okay. I mean, yeah, you can write these formulas together only. So there is something called as total investment expense, TIE. Okay, so it is nothing but it is uh, in addition to expense ratio, what all other things you pay. Okay, so that is nothing but the front load and the back load divided by n. Okay, so n is number of this thing. What you say? Number of years for which you are invested in the mutual fund. Okay, so this is the total investment expense for you, for the investor or the retailer that is purchasing that fund. Okay, so maybe we can take one problem so that you understand what we do in these cases. Okay. So, you know, they have given that at the start, the AUM under management for your fund was 120 crores. Okay. And after 1 year, the AUM under management is 180 crores. Okay. So you have increased, the mutual fund could increase it by 60 crores. Okay. And the total annual expenses during this period, because you have to pay salaries, you have to do some advertisements, etc. Nowadays, you must have seen these ads of mutual funds, sahiye.com, all those things. So, there is significant advertisement expenditure also is there nowadays on these, because they usually hire certain celebrities which are well known, and therefore uh, you will get good subscription to your mutual fund. Okay. And then they have given you the front load as or entry load as 2%, and the back load or exit fee as 1%. Okay. And you need to find the total investment expense for you for this year. Okay, so in this question they are talking about only 1 year. Not necessary, they can talk about n number of years also, but in that case the expense ratio that you calculate should also have the total expenses for those many years, and the AUM also should be considered between the start and the end of that nth year. Usually these things are considered on annual basis, so that is why I'm taking this problem. Okay. So here first you need to find ER, which is your expense ratio, that is total expenditure, so that is 3 crores divided by average AUM, that turns out to be this is 300 by 2, so sorry 300 by 2, so 150, so this is 1 by 50. Okay, and if you multiply by 100 to convert this into percentages, so this comes out to be 2%. Okay. So every mutual fund manager wants to reduce this number, and how do you reduce? Either reduce the numerator, so that means you need to do some after like certain limit, because how much employees can you fire, or how much advertising budget can you slash? You can't do much thing in the numerator. If you are spending lavishly, then you can do, but if you're already on very thin staff, etc., you can't do much on the numerator. So the best way to decrease ER is to increase the denominator. So you have to make your fund as big as possible. In that case, the expense ratio usually turns out to be very less. Okay. And then total investment expenditure or expense is nothing but expense ratio plus this front load or entry fee plus back load by number of years for which you are in that fund. So this is 2% plus this is 2 plus 1 by 2. No, not 1 by 2, 1 only, because we are talking about 1 year. So this comes out to be 3.5%. Okay. So if see, in the end the mutual fund is taking this everything from you only, right? So effectively this says that you are approximately paying 3.5% per year for this investment as an expense. Okay. And then you can use this parameter to compare two funds also. Okay. So let's say among two mutual funds A and B, if the total investment expense for mutual fund A is less than total investment expense for mutual fund B, this implies that uh, fund A, mutual fund A, is more cost efficient than mutual fund B. Okay, so you can use this parameter of TIE for these things also, comparison of different mutual funds. Okay. Okay. So then there was discussion on this RVR, which is called as pivot to variability ratio. Okay. Again, there is another name for this also. This is called as reward to variability ratio, RVR. There is another name for this, which is called as Sharpe ratio. So these are nothing but you know uh, this gives you the incremental uh, rate of return above the risk-free return for the risk that you are taking. So this is nothing but uh, excess uh, rate of return generated over risk-free return for unit risk. Okay, so that means uh, for unit of total risk, not unit risk. So that means, and this risk is usually considered as, in terms of standard deviation. So this total risk is measured by standard deviation. Okay, and what is the securities? Uh, on a global scale, this US Treasury bills are considered as risk-free returns because the chance of default of US government on its commitments is considered as negligible. But that was before, I mean, till last month. But nowadays, considering these tariffs and all, I don't know. Anyway, so that is in the context of India, if you are purchasing government securities or government bonds, etc., that is called as risk-free return because Indian government, you know, will pay those things back to you in any case. Okay. Yeah. One second. Okay. So we can take one problem rather than going into this formula and all, so that you understand what it means. Okay. So there are three funds. Okay. So mutual fund A, B, and C, and this is their return for certain period. Okay, let's say consider one period. Okay, so mutual fund gave the return of 11%, B gave the return of 13%, it gave the return of 10%. Risk free rate will be usually same for all the funds because we assume that they are operating in same geography. Whereas the standard deviation in this return that it generated, standard deviation is nothing but the measure of the dispersion of the data relative to the mean of it. So that means the volatility, basically how volatile was this fund throughout the period. Okay. So if you just look at the returns that it generated, you can just say that mutual fund B was very good, or it is the best option. But at the same time, it was very fluctuating also. Okay, so many times investors don't want lots of fluctuations. Okay, so this is nothing but the common measure of risk is nothing but standard deviation. Okay, so therefore this RVR for you know if you calculate RVR for, let's say, mutual fund A, B, and C. So RVR is calculated as excess return. So that is nothing but 11 minus 4 divided by how much standard deviation was there. So that is nothing but 7 by 8. Okay, so that comes out to be 0.875. Some may uh, uh, you know uh, express this in terms of percentage also, but doesn't matter. If you are doing comparison, compare everything in fractions. Whereas this B produced 11% of excess return, but at the cost of 12% of the standard deviation. So it is 9, not 11, 9. Okay. And the mutual fund C only produces 6% extra return, but it is not also having very much fluctuations. So that means 6 by 6, so that is 1. Okay. So if you look at the RVR for mutual fund C is greater than the RVR for mutual fund B, that is greater than the RVR for mutual fund A. Okay. So this means that this mutual fund C is the best option if you want both. If you want good returns also and less risk also. Okay. So this is called as best uh, risk adjusting performance. Risk adjusted performing mutual fund. Okay. So the main point is, don't just look at how much excess returns you got. You should always look at how much risk you took. Okay, because taking higher risk is not advisable all the time. Sometimes, if you are confident, you can do that. But if you keep on taking risks, there is a chance that one or two times you will get caught in the unfortunate events, and then whatever returns you had accumulated, everything will be gone. Okay, so that's why you have to take risk. Always risk involved in the stock market. For example, this diagram was shown by professor also in the class. Okay, so there are two types of risks. One is called as controllable risk, and another is called as uncontrollable risk. Okay, so when you operate under uh, in stock markets, there is certain types of risks which go down if you do diversification, etc., etc. Okay. So this part is called as uncontrollable or unavoidable, avoidable or systemic risk. Okay, so you can't do anything about this. You have to bear with it. What you can reduce is this much. This is called as controllable. Okay, there is one more name to it. Yeah, diversifiable risk. Okay, this also is called as undiversifiable. See, for example, in today's context only, Indian market is supposed to fall. It already fell Friday, but on Monday also it is supposed to fall. I don't know how much, nobody knows, but the consensus is it should fall because the US indices have been like 5-10% down in last 2 months, 2 days. Okay, so therefore, you know, uh, that is something that is, however how much diversification you do, you can't do anything about it because you know it will, you know it is across the board if you have only equity in your portfolio. But let's say along with the equities, if you had purchased some gold, so in that case, when the equities fall, usually the gold prices rise because of the uncertainty in the global scale. Okay, this happened during COVID also, and during this also, this tariff tantrum. Okay, so that is what you can do to control your portfolio risk or the portfolio volatility. Okay, so basically, if you compare these mutual funds ABC, mutual fund B operates very close to the y-axis, and mutual fund C operates very far away from the y-axis in this case. Okay, so that's what these things mean. Um, that is one thing. Apart from that, yeah. Then this was about yeah, systemic risk. Okay, so this is again denoted by usually denoted by beta symbol. Okay? And the formula says that you have to take covariance between Ri and Rm divided by variance of Rm. Okay. What is Ri? Ri is nothing but the return generated this thing, the return generated by the fund. Okay, and Rm is the return generated by the market. So that is free market return. Okay, so you compare with the variance in your market, what is happening with your this thing. Okay, fund. Okay, so this covariance is very important concept. Okay, many times. I mean, those who study random variables, etc., and probability distributions, they may know this. But covariance is usually, this thing, uh, how one variable performs with respect to another. Okay, so this covariance, is not cos. Sorry, covariance of x y. You divide this by the standard deviation of x and y variables, and then you get something called as correlation coefficient. Okay, and that is always between -1 to 1. Okay, and that tells you if it is +1, that means this x and y both perform similarly. Okay, for example, if you have two stocks in same sector, for example Infosys and TCS, they both belong to the IT sector of India. So if Infosys increases because of certain favorable reason, it is highly likely that TCS stock will also increase, right? So that is called as positive correlation. So this is called as positive correlation. Okay, and this is called as negative correlation. That means when one thing increases, other thing decreases. For example, Indian equity market compared to the gold, price of gold. So in that case, whenever some global uncertainty comes into the picture, the equity markets fall and gold prices shoot up. Okay, so that is called as negative correlation. So usually what they say is in your portfolio, it is better this negative correlation assets, such assets reduce the portfolio risk. Okay. Okay, so they reduce your overall portfolio risk, but see again, I mean, risk is there. they reduce only this controllable risk, etc. But the issue is, for example, let's say you had same amount of money in gold and some same amount of money in Nifty, and let's say within a month, because of some tariff issue or something, Nifty fell by 10%, gold rose up by 10%. So overall, your portfolio is intact. I mean, nothing changed, right? It is plus percent, plus 10%, minus 10%, and since the distribution was 50-50, you did not gain anything and you did not lose anything. But see, that is what they call this as, reduced risk because of negatively correlated assets in your portfolio. But the drawback is you did not generate any profits also, right? During that month, it is zero. So the investor, this preference will change, okay? Because not all the investors prefer to be playing very safe. Okay, even big investors like Warren Buffett, etc., they have also said these things, that you only need 2-3 good stocks to make your life peaceful. Okay, so the point that I'm trying to make is, I've seen some examples of some of my friends or somewhere, they have like 50-60 stocks in their portfolio. Uh, so even one or two stocks out of them become 10 times. Even in that case, they, on an overall portfolio scale, they only have like 2% or 1% effect, which is not good, right? I mean, uh, one stock in your portfolio became 10 times, but still overall portfolio only increased by 1% or maybe 2% if you have 50 stocks. Okay, so in that case, I mean, not good, no? I mean, when will your portfolio become 5 times in that case? Okay, so therefore, it is usually said that if you have, let's say, 5-6 stocks, then you can have, I mean, that is a risky endeavor, risky portfolio, but that will give you high rewards also. But if you have more than 20 stocks in your portfolio, that is usually it is mimicking the index only. Okay, so it is better to buy that index itself rather than buying every single stock. Okay, that is one piece of information that you should have. Okay, and apart from that, I mean, this covariance between this thing, there is a mathematical formula, okay, for this covariance of x and y. See, covariance is always defined between two variables, okay? It is not defined. I mean, you can define it in terms of one variable, but it doesn't make any sense. Okay, so it is denoted by x minus x bar. So this will be xi, y minus y bar, yi divided by n. Okay, and this goes from I to 1 to n. Okay, so this y bar means the mean of x values and y values, and xi means individual entries. So basically, you do multiplication of these. Okay. Then there was discussion on options. Okay, very interesting topic. See, you should know some things about markets. Okay, types of markets, or yeah, let's say types of markets. This is one of the classifications. So there is one market which is called as cash market. So this is where you purchase number of shares by paying the price, whatever it is, plus some fees, etc., whatever brokerage, etc., and then you own those shares for infinity. So if you want to sell them, that's at your own discretion. Then there is something called as derivatives market. So derivatives, as the name suggests, it is derived on some underlying equity or stock or index. Okay, and then there is something called as commodity markets. Okay, so commodity markets include crude oil, gold, silver, aluminium, currencies, various types of currencies. Okay, and now there is actually a third market which is called as cryptocurrencies. Uh, but let's consider that into commodities only, because conventionally we study these things in these three categories. Okay, so these options are part of derivatives market. So there are two derivatives. First is called as futures, and second is called as options. So you should know first of all what are futures and what are options. Okay, these are these derivatives market, or these instruments, futures and options. They were invented for hedging purposes. Okay, that means let's say you have a big portfolio of, let's say, 10 crores. Okay, so you have like a big portfolio of 10 crores, and let's say you have invested it in index only, because you did not want to take much risk with your hard-earned money. Okay, but the thing is, even the indices are supposed to be fluctuating, right? Because let's say in this taper tantrum of US markets right now, their indices have fallen 5% in one day. During COVID also, the indices had fallen 10% in one day. It rarely happens, but it happens, no? And then if let's say 5% fall, that means 10 crore portfolio, 50 lakhs is gone. You will be under huge panic, right? Because within a day, 50 lakhs from your portfolio is gone. So such things, even indices are not safe or not stable in such certain scenarios. So that's why they had invented these options, futures and options. Uh, I'll show you directly on the Sensible website only what it means. So those things are there. But before that, you should know why we have derivatives market and why we have options right now. After COVID, it has happened all over the globe that many people have entered the stock markets or equity markets, and they have first they come to know about cash market, because that's the commonly known market. But the drawback is, in cash market, if you want to purchase some shares, if you want to take the delivery of shares, you have to pay uh, full money upfront, right? Let's say I want to purchase Kotak Bank of one share of Kotak Bank, that is around 2100 now. So therefore, I need to upfront give 2100 to the broker, and then he will give me one share from the exchange. But in futures and options, if you purchase the future, you don't have to pay 2100 upfront. You can only pay 40% of it. Okay, but that doesn't that means these will not. I mean, why will somebody give you the share only for 50% or 40%? Because that is not your ownership. That is a limited ownership. After 1 month, it will be taken back, like that. You can give it back within a month, but uh, it will be taken back if you had purchased futures or options for that expiring that month end. Okay. So now what is happened? Instead of hedging, people are doing the business of options itself, and that is the problem. First of all, understanding cash market is different. Understand market or these futures and options, these are purely mathematical uh, these things, formula based pricing models. And usually what they do, they take the historical volatility as one of the functions in the formulations, and based on that the option prices or future prices are decided. But you should know these variables, right? Then only you can make money. So that's why the SEBI keeps on giving these reports where they say that 95% of retail investors lose money in the options market. I mean, that is bound to happen, right? Because nowhere in our education system we teach anybody about financial markets. Only after your bachelor's, if you are not from finance background, most of the Indian graduates are not. Only after that, if you go to the MBA and that also finance, only then you will know about these things. General public doesn't know. And after COVID, what happened? Everybody got into this cash derivatives, etc., etc., because people were quarantined, right? So, and after that, many lost their jobs also. So they don't have anything to do. And now with the advance of this mobile and all, uh, Okay, so yeah, what was I saying? Ah, so that is the issue, that instead of hedging, people are doing this options trading based on some YouTube advices or some Telegram advisors. Uh, that's not right. If you don't know anything, you should learn it if you want to use it. Okay. Many people don't want to. See, one classic case of scam I will tell you. In these options, there are two options. Okay, something called as put and call. Okay, so I will create two accounts with my broker, and I will purchase the put option of the same stock or index in one of my account, and I will sell the same stock or the same put option for that same stock in my another account. So if the stock goes up or down, you will have profit in one account, you will have loss in another account. So in that case, uh, you know, what I do, I take the screenshot of the account where I have profit, and I post that everywhere on my Instagram channel, Telegram channel, YouTube channel, everywhere. And I will tell that I got the 10 times money by doing this trade. Okay? Whereas in the other account, I have lost 10 times also, but I don't tell you that. And that is how these influencers, many of them are doing these kind of scams, and raking in a lot of money from the innocent investors. Not innocent, but I would say uh, ignorant investors, because nobody is innocent. I mean, you're voluntarily giving your money to uh, these things, right? Anyway, that's not the point. But the point was, you should know what is these things. Okay, so instead of doing those maths and all, because the various formulas were given by a professor in the class only. This time value and all those things. One thing you should know is, famously all over the globe, they use this Black-Scholes model, okay, for determining this uh, option prices. Okay, Black model used for option pricing. Okay, and one thing that you should know is, see, these were mathematics people, and it's a very involved mathematic concept. Okay, so if you are math savvy person, you should read about this. There are many books on this nowadays. But the thing is, I think Warren Buffett or this Charlie Munger, somebody had asked them about this. That do they use this Black-Scholes model or Black-Scholes model in their investment decisions? And they gave one quite interesting remark that this maths is okay if you want to do the predictions for short term, like let's say a month or so. Then this model predicts the option prices quite accurately, because we'll see there is one variable which goes as the input to this model, which is called as uh, IV, implied volatility, or in some cases they use historical volatility also, but in some cases that is called as IV also. So whatever IV or historical volatility that they use for doing this modeling, it is based on the historical prices. Okay, whatever range you want to take and however long data you want to take, that's up to you. But again, that means that this model also takes historical prices into account and then predicts the option prices in some nearby future. Uh, Said that it is satisfactorily accurate for short-term predictions. But if you want to do some long-term predictions, like let's say today Nifty is at 23,000, and where will it be after 2 years? So in such cases, you cannot rely on the historical data much, because you only have like 20 years of good data as far as Nifty is concerned. So based on that, if you do the prediction for next 2 years or 5 years, that is going to be wrong. Okay, and it can be horribly wrong also. So that's what. And that's the key takeaway, that this Black-Scholes model is okay for option pricing when you use across the globe because there is no other model. But the thing is, it's not the perfect one, especially if you have long-term expiries. Uh, there are a lot of places where you can have very upside option prices. Okay, we usually don't come across those things because in India, mostly 95% people usually do short-term trading only, mostly intraday only. So they don't come across these things. But if you are a long-term investor in options and all, leaps, they what they call in US, then you have to be careful how this Black-Scholes works. Okay. So what I'll do, instead of giving you the formulae, because they have been given to you by professor, and you can revise those things. I will directly show you the real example that we can use. Okay. For example, what do I mean by that? This there is this interesting uh, website which is called as Sensible. Okay. So this is the interface. So this is a paid subscription. If you are interested, you can look into it. The thing is, if you have Zerodha account, then it's free also, so no need to pay anything also. So the thing is, here you can study all these things very easily. Okay, this is quite interactive and quite easy to understand. Okay, so there was some mention of straddle, strangle, butterfly, horizontal, vertical spread, etc., etc., and then those things you can uh, you know clearly study in this. Okay, so this is called as a strategy builder tool in the Sensible case. There is some obsta is also there, but this is also there. Okay, so I'll directly show you what do you mean by call and put all those things. Okay, so let's say we consider our Nifty. So here you can see there are something called as futures. Okay, so futures are nothing but and they are expiring. Okay, so this expiry means this future is valid till 24 April only. After 24 April, it is going to expire. It will be same as the Nifty price on that day. Okay, so like that. For example, let's say if I buy the futures of Nifty expiring on 24th April. Okay, so in that case, uh, see, you can see the payoff chart. So here you can see that the green area represents the profit, whereas the red area represents loss. Okay, so that means if let's say this underlying Nifty increases by 1% tomorrow, I will get 9% profit. Okay, and the reason is because you don't pay full money upfront. You only pay, if I'm not wrong, yeah, here it is. Yeah, see, you only pay 2 lakhs. Okay, whereas if you go and buy this in the cash market, this Nifty equivalent of stocks in the cash market, you may have to pay like 6 lakhs. Okay, so that's why. So Nifty goes up by 1%. So if you have all the cash position, it will go up by 1% only. But if you have the futures position, it will go up by 9%. Okay, so that is the lucrative this thing that captures many of the retail traders. Okay, that they think that why do I have to purchase it in cash? Because if I purchase it in futures, I am getting 9% return instead of 1%. Okay, they forget this red part. Let's say tomorrow if it is opening 1% down, which is more likely to happen uh, because of this tariff and all. So instead of 1% loss in your portfolio or in your this investment, you will have 17 or 9% loss. Okay, so therefore this is called as double-edged swords. Okay, so therefore futures, if you are like 100% sure that market will go up or down, then only it makes sense to dwell into futures. Okay, so the risk is infinite. Okay, on the bottom side, that is called as unlimited risk. For example, let's say tomorrow COVID-like situation happens, then the market will open 10% or 5% down, and you now imagine if it opens, let's say, 3% down only, your loss will be 26%. Okay, so imagine the loss. Even in the US market yesterday, the market fell by 5%. So if somebody had gone long in the futures on S&P 500, uh, that guy's capital would have been gone. Okay, so that is why these futures are not good idea, is what I'm trying to tell you. But still, people use like, hello, you should use this in some another context also. So what we can do is, see, instead of buying this future, okay, let's say I bought the future, and what I'll do is, mm, along with this future, I will add some put option also. So let's say, let's keep the same expiry. So what I'll do, I'll buy one put option. Let's say this 23,000 put option. If I do that, what happens? See, now the downside risk is limited. No, it is what? How much is it? It is only 18,000 max to max. So if Nifty opens wherever tomorrow on the downside, you will not lose like 50% or 60% of your capital. At the max, you can lose is 22%. So this is what buying a put option means. Okay. So maybe I'll just remove this future here. Okay. So now I'm just buying purely the put option. Okay. See, if you are good, if you are expecting market to go down, that is called as being bearish on the market. So that is when you buy put options. Okay. Percent down, I will have the profit of 9,500 rupees. And how much am I paying for buying this put option? I am paying only 21,000. Okay, so that is the advantage when you buy put option. When the market goes down, you will make good money. Okay, but at the same time, the time is your enemy. Okay, so I'm increasing the time. So this is now 10 April. So if everything remains same, okay, so then what happens? This all of these options, put and call and everything, these are called as time decaying options. Okay, so if you are at the expiry, their time value will be zero. Okay, so that means the premium that they command before the expiry is gradually decreasing always. Okay, so therefore, if you are option buyer, what you are expecting is the immediate price move up or down. You are not expecting immediate price move after, let's say, 1 month or so. Okay, so that is the difference between buying option and selling option. Selling of the option is also called as writing of option, because see, when you are buying this option, somebody should sell this, right, on the other end. So that is called as seller. So the premium of 20,000 that you pay to buy this option is deposited into the account of the seller. Okay, it's not his money. If you tomorrow you get this 9,000 as the profit or this 8,000. Okay, so it is always transactional. Okay, so this is about put option. Okay, what you can do is, instead of buying this put, uh, I will make it a call. Okay, so I bought this call. 1 second. Yeah, now see, the trade-off or the payoff chart is reverse to what it was for put option. So in this case, what you expect is to market to go up significantly in the short span of time. Okay, if the time is more for the upside move, it is not advisable to buy the call option because its price keeps on going down. The time value premium decays in all the options. Okay, you should know this thing. There are this option pricing model or this Black-Scholes model. It has certain number of variables that it includes. Okay, so the one variable is called as delta. That means if underlying moves by 1 unit, how much the option price will move. So here it is plus 47, right? So that means if Nifty moves by 1 point positive, you will have the profit of 47 rupees. Okay, if it is decreased by 1 point, you will have loss of 47. Okay, so like that. Theta represents the rate of change of delta. That uh, if it is negative, that means you lose that much. So this is indicating the loss of the time value premium, right? and this dk represents uh, what happens if the IVs fall. IVs, as I told you, that is implied volatility, and that goes as one of the variables into the Black-Scholes model. So if this number is negative, that means if the IV increases, you will be in profits, and IV decreases, that means you will be in loss. Okay, so like that. So since you are a call buyer here, your IV will be negative. That means you want IV to go up. You don't want IV to go down. Okay, and this gamma is nothing but rate of change of delta. Actually, not the. I think I told theta. It's not like that. Gamma is rate of change of delta with respect to the stock price. This is important number if you are very close to expiry, because when you are very close to expiry, option prices decay significantly faster. In that case, the rate of decay is important, which is represented by gamma. Okay, and then there is this vega. Vega represents again this IV. Okay, IV going down and up. Yeah, this decay represent, I think, time value. Yeah, the decay in the time value, and vega represents the IV change. Okay, so these five variables are there which determine the this thing, option of variation of option price with respect to time. Okay, so this is your uh, option buying, but there is no need to do that always. Okay, you can do option selling also. So for example, this. Okay, so in this case, when you sell the option, you expect market to go down. Okay, so let's say it goes down, so you will make profit of 7,000, and as the time goes, like time the expiry comes nearer, the values of uh, calls and puts both drop, and that is called as this thing. That is beneficial if you have sold the call. If you have bought the call, the value going down is not good for you. Okay, so that is one thing, and then there are multiple strategies that you do. For example, they had mentioned something straddle or something. So what you can do is, see, there are some bullish strategies. Bullish means you are expecting market to go up. If you expect it to go up suddenly within next 1 or 2 days, you buy a call. But if you are expecting it to gradually go up, or by the end of this month or something like that, then it is better to sell the put option. And then there is something called as bull call spread and bull put spread. Then there is something called as call ratio back spread, calendars, long calendars, bull condor, bull butterfly. Butterfly was mentioned in your notes also. Okay, so all those things are there. Maybe we'll just see what is bull call spread. So in this case, what you do, you buy one call and you sell one call, and then your payoff chart looks like this. So this is a limited risk, limited reward strategy. So tomorrow market falls, you don't have to worry. Max you can lose is 5,400, but you can get 9,559 if the market goes up from here. Okay, so this is the bullish wala thing, but you can do bearish also, right? Because let's say you think because of this tariff and all, the market is going to go down. How much down you don't know, but you think it is bearish. So if you think it will be a big move, you go and buy the put option. And if you expect it to be a sudden move, but if you expect it to be a gradual grinding move towards the downside, you can sell well call also. And similarly, you can sell bear call spread or bear put spread, anything you can do. Okay, so this is called as bear put spread. And how will it look? It looks something like this. One second. Yeah. So here also you can lose 5,000 rupees max, and you can gain 9.6 thousand rupees max. This is called as bear put spread. Okay, but you can do one thing also. You can do bear call spread also. So in that case, what happens? Your this downside will be more, your upside will be less. Okay, so that is the problem. So you usually don't do bear call spread. You usually do bear put spread and bull call spread. Okay. So that is one thing. Now there is some calendars also are there. So in calendars, usually if you are doing the same strike price, you change the expiry, or if you are doing same expiry, you change the strike price, or you can do both also. That is called as cross calendar or diagonal calendar also, I think. So in that case, uh, it looks something like this. So here you take the advantage that the longer expiry calls will decay slowly rather than the shorter expiry calls or puts also. Okay. So since this is a put wala spread, so therefore it benefits if the market goes down. If I do call wala spread, it will benefit if the market goes to the higher side. And now you see, as the time proceeds, I am just doing this simulation ahead by 1 day. See, it is giving you more profits, right? So these are called as limited risk, limited reward strategies. Okay, buying a naked put and naked call is called as limited risk, unlimited reward strategies. Selling a put and selling a call is called as limited profit, unlimited risk strategies. Okay, so there are different trade-offs, and based on that, your margin will be decided. Because if you are selling a call or something, you have to you will get the premium from the option buyer, but you have to give some margin money to the broker or exchange. That is like the commitment that you will return the premium tomorrow. You will not run away with the premium. Okay, and then there are certain neutral strategies. For example, you think that the Indian market has already corrected from 26,000 to 20,000 and it will not go down much from here. It will stay around 24,000. So in that case, what you can do some short straddle. Okay. So in short straddle, let's say instead of 29, I'll do 23,000 short straddle. Okay. So then how will it look? It looks something like this. So it's like a triangle. So this is called as limited reward, unlimited risk strategy. Okay. So here the risk is if what, let's say tomorrow if happens. So in such cases, okay, yeah. So in such cases, you need to protect your downside, and there are various ways to do it. What you can do is you can just go and buy some put option on the downside. For example, uh, this is 23,000, right? So I'll go and buy this put option. Okay. So in that case, oh, the expiry is different. 1 second. Yeah. So instead of 24 April, I will buy it at 9 April only. Okay. And now you see your downside is limited. So, and then there are this butterfly, etc., is there. Since they were mentioned in your class, I'll just show it to them. See, this butterfly involves 4 legs. Okay, buying, selling double, buying again. Okay, and they will always have like this shapes like this. So limited risk, limited reward. Okay, but usually what happens? This will be very short range, very high. So what do they do is they create multiple butterflies. Okay, for example, this is one butterfly. So this is created at 2900, right? So what I can do is I can create one more butterfly. Okay, 1 second. Yeah, let's say this is one butterfly, and instead of doing this, what I'll do, I'll just add myself only. 1 second. Instead of 20 to 900, okay. So I can create one more butterfly. That will be, let's say, buying this, selling this, double the quantity, and then buying something here. Okay, so this is also one example of butterfly. If you do that, how will it look? Oh, I think we mumbled up the expiry. No, no. 1 second. So put options. Oh, acha, acha, acha. Bottom or put and top or sell call. Okay, so I can buy this put and sell this, or maybe this strike price I will sell. I will sell one here also and I will buy one here. So that is called as double butterfly. Okay, so here you see there are two peaks now. Okay, so that is how people manage these kind of things, because when your payoff range is very small, you have to do this kind of adjustments. Okay, and then if you see with respect to time, you see you'll get different regimes. Okay, so that depends on time also. Okay, so you can play around with these things. Okay, so this is about. Oh, one second. Yeah, here I have to go. Okay, so this is about butterfly, and most likely people follow these kind of things. This Batman is also there, but Batman is expecting big moves on both the sides. Usually, these kind of things are not quite commonly used. Some may use, but the most common, some of the most commons are this triangle. This is called as short triangle. There is something called as long triangle also, in which you buy the call and put at far or not at the same strike, slightly at the distance. In these strategies, the point is, or the drawback is, if the market moves, you will have high net M2M losses, mark to market loss, red, so which you don't like, right? So therefore, you need to know how to adjust these kind of strategies. Otherwise, don't do it. So I showed you different strategies, but the one that I wanted to show is, or the basic idea of this thing is, I told you it is for hedging purposes. Okay, so what usually is done is, you just buy one future. Let's say I buy this 24 April future, and then I buy one put option also as the hedge. Okay. So in this case, what happens? I don't. Oh, it should not be call. It should be a put. Okay. So in this case, your downside risk is limited. Okay. So this is the main purpose for which options were invented. And then people play around with this also. What they do is, they will sell one call also along with this, some out of the money call. Let's say this guy. Okay, so you bought the put option at 266, so you can uh, you know collect that much, half of that money by selling the call. So in such cases, you will have something like this. And the thing is, your downside keeps on going down. If your maximum risk is 13,000, but earlier, if I don't have sorry, if I don't have this call option, my downside is 21,000. Okay, so basically, I'm trying to save that much. So therefore, instead of one, you can do it twice. Okay, so in such cases, see, now that is everything practical I'm telling you, and depending on all those five variables, theta, gamma, decay, vega, all those things, these things, delta, all those things, everything keeps on changing. Okay, so this is a practical use of options. Usually, it is said that you should do some paper trading or some virtual simulation before actually doing the options, because it looks very good on the paper because it's all maths, but when you do practically, it is not that easy. It takes a lot of effort to master these kind of things. Okay, uh, so yeah, that is one thing. So with that, we'll stop. And before we move on, see, there is you might see there are two lines here, right? For example, see, there is this blue line, right, which is going from negative to positive. This is the line which is predicted by Black-Scholes model. Okay, so that is called as current price of your strategy. The final straight lines that are shown from the red to green region, these lines are at the expiry. So that means at the 24th April, this will be like looking like this, or in this case, I think it is 9th April. Yeah. Oh no, 24th April. So see, you observe this blue line. It will eventually coincide with the straight lines. Okay, because eventually at the expiry, your options, whether they are in the money or out of the money or at the money, everything will coincide with the payoff chart. Okay, so that is what is the meaning of decay of time value. Okay, so this is practical application of your options and various strategies. This Sensible tool is free for Zerodha users, or otherwise there is one called as Opstra. Okay, you can use that also. For example, yeah, this Opstra. Okay, so this is also one of the tools. Okay, so here also you can build these things. So this is free for all. Okay, and here also you can see bullish, bearish, non-directional, all strategies they have given you. For example, bull call spread, you get something like this. Okay, so like that, there are multiple tools nowadays. You can use all of them to learn this. This is an interesting concept. If you have a real portfolio, you can hedge it using these things. Okay. So with that, we'll stop, and other things you can study from the class, whether this intrinsic value, time value, and all those things. But I thought I'll give you some practical flavor of these things, because this theory is there already taught to you. Okay. So with that, we'll stop and see you next time. Okay. Bye.